Welcome to the Deep Dive, where we crack open earnings calls and pull out the insights that really matter for you. Today, we're digging into Franklin Covey's third quarter 2025 earnings. And, well, it's quite a story.
It really is. You've got management juggling some pretty clear external pressures, things hitting their clients, but at the same time, they're pushing hard on these big internal changes, trying to set up for growth. It's a real balancing act we need to unpack.
Okay, let's jump straight in the numbers. Third quarter fiscal 25. What did we see?
All right, so revenue landed at $67.1 million. That was basically what they expected, right at the low end of their guide.
Right, so no big surprises on the top line, but what about profitability?
That's where it gets interesting. Adjusted EBITDA, that came in at $7.3 million. And that actually beat the high end of their range. They guided $4 to $6.5 million. So, a nice beat there.
Okay, 7.3 million. That's definitely better than expected.
Yeah. And what's fascinating is, revenue was down 9% year over year. And it's down 4% for the year so far. Mm-hmm. But sequentially from Q2, it was up to 13%. So some momentum there. But that EBITDA beat, especially with revenue down year on year, that's pretty noteworthy. It shows they're managing costs. And gross margins held up too, 76.5%. Basically flat compared to last year. Solid.
Okay, so top line pressure, but bottom line outperformance. Let's dig into those pressures. What exactly did management say was hitting the revenue side?
Well, they were pretty specific. Government actions were a factor. They mentioned canceled U.S. federal contracts directly. And then, broader stuff like geopolitical trade tensions, plus just general economic uncertainty.
Makes sense. Companies getting nervous, scrutinizing spending.
Exactly. Delaying decisions. And that hit both their enterprise and their education divisions.
Yeah.
Which led them to update their full year outlook.
Right. So what does that revised guidance look like now for the full fiscal year 2025?
Okay, so for revenue, they're now guiding $265 million to $275 million. Part of that reflects the ongoing uncertainty, but also a timing risk. Some Q4 deals might actually see the services delivered and the revenue recognized in Q1 of next year.
So a potential shift, not necessarily lost business.
Could be. But what's really interesting is the EBITDA guidance. Despite lowering the revenue outlook, they widened the EBITDA range to $28 to $33 million.
Yeah.
The midpoint and the top end are basically the same as before.
Okay, wait. Lower revenue guide, but keeping the profit outlook mostly intact. How are they pulling that off? That points to something else going on.
Absolutely. And this is, I think, a really key part of the story. Management talked about completing some pretty significant cost-cutting actions in Q3, mostly severance, things like that. Cost them $4.7 million in the quarter.
Okay, a restructuring charge?
Right. But listen to the savings. They already got $3 million in savings back in Q3 from this. They expect another $4 million in Q4. And the big number, they're forecasting an $8 million annualized run rate saving for fiscal 2026.
Wow, $8 million annually. That's substantial.
It is. And they were careful to say these cuts were disciplined. Right-sizing where needed, optimizing the go-to-market plan, but crucially not hurting their main strategies or their future growth plans.
So trimming the fat, not cutting into muscle, playing defense on costs while still trying to push forward on offense.
That's exactly how it sounds.
Okay, let's talk about that offense then. Their core business, especially that enterprise North America transformation they've been highlighting. It's pretty new, right? How's it actually doing?
Yeah, only about 180 days old, so still early innings. But they say it's gaining traction. They split the sales team, remember. One focused on landing totally new clients, the hunters, and the other on expanding within existing ones, the farmers.
Right, the land and expand model. So what signs are they pointing to that suggest this is actually working? What really stands out to you?
Well, they gave 5 key indicators. For me, a couple really pop. First, new logo performance. They actually sold more new logos in Q3 than they did last year.
Oh, interesting, despite the tough environment.
Yeah. And often with more subscription services attached, so the average deal value per win is up. They gave an example. A $2.3 million deal with a big information management company closed in under 50 days. And that included their new AI sales coach tool.
Wow, fast closing, big value, includes new tech. That's a good sign. What else?
The second one I'd highlight is expansion within clients. This looked really strong. They saw a 15-point increase in clients expanding outside their normal renewal window compared to last year.
Okay, so clients aren't just renewing, they're actively buying more, even between cycles.
Exactly. Proactive expansion. The example here was a global packaging company. Started with 200 users, grew to 1,000. That added $136,000 in new annual subscription revenue, and they think there's huge multi-year potential across the client's whole 50,000 person workforce.
That's the land and expand dream right there.
Pretty much. And the other indicators support this too. High client retention, more clients signing multi-year all-access pass deals. That percentage went up from 55% to 58%.
So locking clients in for longer.
Yeah, shows commitment. And they have a really high attachment rate, like 60% for their key subscription services in enterprise. Even now, when companies are cutting consultants, clients are sticking with these services.
Okay, so the sales transformation seems to be bearing fruit, at least in these early stages, and they're backing this up with marketing too.
They are. Brought in a new CMO, Darush Pazuki. And yeah, the marketing efforts seem to be generating leads. They mentioned things like their Impact Conference, 27,000 registered, webcast getting 4,000 attendees. That's feeding the pipeline for both new business and expansion.
All right, that's a pretty positive picture on the enterprise side, despite the macro stuff. What about education? That division seems like it's facing its own headwinds, right? Like the talk about closing the Department of Ed, ESSER funds running out.
Yeah, you'd think so, but education continues to be, frankly, remarkably strong. They're actually expecting year-over-year growth there, both revenue and profit.
Really? Growth despite those challenges.
Yep. New school signups, retention rates, they expect them to be as good as last year, maybe even better. Subscription revenue in education was up 13% in Q3. And deferred revenue, the money booked for the future, that jumped 21%.
21% increase in deferred. That's huge visibility.
Massive. It shows the demand is there.
Yeah.
Their Leader in Me program is really clicking. They're moving beyond selling school by school to selling whole districts, even statewide deals. Almost 8,000 Leader in Me schools globally now.
Wow.
So that slight dip in Q3 education revenue, they chalked it up to timing on some big contracts closing, not a fundamental demand issue. It seems like a real engine for them.
Okay, so the overall picture feels like, yes, macro headwinds are real, but they're executing internally, both on costs and on strategy, particularly in education and the enterprise transformation. What about the broader financial health? Balance sheet, cash flow?
Looks solid. Liquidity is strong, over $95 million available. That includes about $33.7 million in cash they have on hand. And importantly, they haven't drawn anything down on their $62.5 million credit line. So plenty of flexibility.
And they're returning cash to shareholders too, right?
They are. Bought back 372,000 shares in Q3 for $8.3 million. Still have authorization for another $27.9 million under the current plan. Shows confidence from management, I think.
Definitely. Now, you mentioned AI earlier with that sales coach deal. That caught my ear too. How else are they using AI? Is it becoming core to what they do?
It seems like they're really leaning into it. They said 43% of clients are now using that AI coach feature. They see it as a way to bring coaching to more people, democratize it because it's lower cost and scales easily.
Makes sense. Scaling services efficiently.
Right. And AI is also helping them customize and personalize their content faster and cheaper. That used to be a pretty heavy lift for big client engagements.
Yeah.
So it's becoming part of their delivery model, making them more efficient and maybe more effective.
Okay, so we've covered the quarter, the strategy, the cost cuts, AI. Let's pull it all together. What does this mean for you, the investor, looking at Franklin CVY right now?
Well, you have to acknowledge the reality. There's economic uncertainty out there, and it is impacting client decisions. It's slowing things down. And while the new logo wins and the expansion numbers look good, the challenge they mentioned is some existing clients are actually downsizing their current subscriptions.
Ah, okay. So winning new business and expanding some, but others are pulling back a bit.
Exactly. And there was also this technical factor. A large client converted their subscription to an IP license agreement some time back. That created a drag on the invoiced subscription revenue metric. So that metric has been kind of flat to slightly down. And that's partly why that big jump in deferred revenue we talked about hasn't fully flowed through to total reported revenue growth just yet.
Got it. So there are some countercurrents within the subscription base and some counting factors at play. But you're saying despite those current revenue headwinds, the underlying engine seems to be building momentum for the future.
That's precisely the narrative management is pushing. And honestly, the data points seem to support it. They sounded quite confident that the cost cuts plus the strategic moves are setting them up for, and this was their phrase, a meaningful increase in adjusted EBITDA and free cash flow in fiscal year 2026.
A meaningful increase. That's pretty bullish.
It is, and it kept coming back to the core strengths. mission-critical solutions, high retention, those strong gross margins, getting cash up front through invoicing, not needing huge capital investments to grow. They really believe in the long-term model, that wide Q4 guidance range. They said a lot of that is just the usual seasonality in education, where a ton of business closes right at the end of the fiscal year.
Right. Okay. That makes sense. All right, let's shift gears. It's time for the part of the show where we put on our speculative hats. Now, remember, everyone, this is absolutely not financial advice. Please always do your own research. But if we had to pitch an outrageous but plausible trade idea for Franklin CVY to an investment committee, what would that be?
Okay, outrageous but plausible. Given that the market's probably laser focused on that revised revenue guide and the macro worries right now, our contrarian trade idea would be go long Franklin CVY, specifically looking for a significant pop in the share price sometime in the first half of fiscal year 2026.
Interesting. Long FC, betting on FY26. What's the core thesis?
The thesis is pretty straightforward. The market is currently mispricing the stock. It's overly focused on the short-term revenue headwinds and undervaluing the impact of those $8 million in cost savings hitting the bottom line. It's also undervaluing the early signs of success from that sales transformation, the land and expand traction.
So you think the FY26 outlook for profit and cash flow could surprise people?
That's the bet, that management delivers on that meaningful increased promise. The current uncertainty, we'd argue, is creating a window, a buying opportunity. We're betting the market eventually wakes up to the benefits of the cost cuts, the revamped sales engine, the AI efficiencies, and that really solid education business. It's basically a conviction play that they can navigate this near-term chop and emerge with much stronger operational leverage.
A conviction play on operational leverage kicking in for FY26. Got it. Okay, that definitely qualifies as contrarian given the current focus. So wrapping up our deep dive on Franklin CVY's Q3, what really stands out, I think, is just how proactive management seems to be. In a tough environment, they're not just reacting, they're making aggressive moves on costs while still investing in the future sales, tech like AI.
Yeah, the message seems very clear from them. Despite the near-term bumps, the timing risks, the macro stuff hitting revenue right now, they're confident in the core business model and believe they're taking the right steps to accelerate growth, especially looking out towards fiscal 2026.
Well, remember, as always, this deep dive is for informational purposes only. It is definitely not financial advice. We really encourage you to take these points, dig into the numbers yourself, and come to your own conclusions.
And maybe something to think about is this dual focus strategy. Cutting costs hard while simultaneously pushing major growth initiatives. Is that the right playbook for times like these? Or is there a risk of trying to do too much at once? Something to mull over as you watch the broader market.
Definitely something to consider. We look forward to connecting with you on the next deep dive.